What's up guys, welcome back to another investing basics video. Today I'm going to be taking you guys through the PE ratio. We're going to be talking about what it is, how it's calculated and what it's used for. Let's get straight into it. The PE ratio stands for price to earnings. It's a ratio between the price of the company's shares to the earnings per share. Now it's calculated pretty simply just by dividing the two. The PE ratio is used by investors to see if it's overvalued or undervalued, and some investors like to look at this as it is a good metric to see, but today I'm going to be showing you guys through how to calculate it, where to find it and that sort of thing. Generally, a high PE ratio means that investors are confident about the future. It means that they're anticipating higher growth in this type of share. The current average PE ratio in the market at the moment is around 20 to 25. This means that each company's share price is 20 to 25 times its earnings. The PE ratio is simply the market value per share divided by the earnings per share. That means that the PE ratio of 20 means that people are willing to pay $20 for every $1 that company earns. Both the market value per share and the earnings per share are easily found on Yahoo Finance or another finance term like that, so you can easily calculate PE for yourself. But the PE ratio is one of the most used financial metrics, so it is already calculated on these sites as well. There are two types of PE ratios, the forward PE ratio and the trailing PE ratio. The forward PE ratio uses estimated earnings per share. The trailing price to earnings uses the actual earnings per shares reported by the company, and so it is a better and more accurate gauge, but it is less useful because it uses past data rather than looking into the future. Now, we're going to be talking about how the PE ratio is used. Value investors are investors that want to get in at the lowest possible price. These guys are looking for the cheapest stocks, and using a low PE ratio, it means that people are willing to pay a low price per earnings. PE ratios are mainly used by growth investors. These are the investors that are looking to buy a company as cheap as possible and to invest it and get as much money back as possible. Like any metric, there is obviously limitations to PE. If a company is losing money, there's no earnings, so there's no PE. Using a PE obviously has its limitations. Like any metric, only one metric doesn't paint a full picture, and it shouldn't be used to compare stocks outside of itself. I'd use only PE to compare against its previous PE or its future PE to see if the company is getting better or worse or lower or higher value. Comparing one stock's PE to another stock's PE doesn't really show you that much information unless the stocks are super similar. One stock may have a high debt and therefore not a very high earnings, or other way around, there might be a lot of leverage at play. So you don't want to use it to compare too widely through stocks.